I'm Charlotte McLeod with investingnews.com, and here today with me is Carley Garner, commodity broker and strategist at DeCarley Trading. Thank you so much for being here. Great to have you.
Of course. Thanks for having me.
Really excited to have this conversation today. I did think, since it's our first time talking, if you could start with a brief introduction to yourself and your work and how you came to be in this sector, that would be great.
Sure. So my name is Carley Garner. I run a boutique brokerage shop in Las Vegas, Nevada. It's a futures and options broker. So we offer speculating and hedging in commodities, crude oil, grains, meats, energies, metals, anything you can think of that trades on the CME exchange or the ICE exchange. We trade it and hedge it.
Perfect. And today, where I wanted to start is with gold. I reached out because I had come across one of your posts on LinkedIn about gold, and I'm seeing a lot of questions from our audience and elsewhere about the recent price activity. Of course, we saw gold at all-time highs earlier this year, and it's in a pullback right now. And especially since the Iran war started, it's come back down. And I think a lot of people are wondering why that's happening, given that gold is supposed to be a hedge against instability. So I wonder if we can start there and take a look at what's going on with gold, what's driving the price right now, and why we are seeing downward action instead of upward.
Right. So the gold market has been a little unconventional. It's basically kind of taken on another personality. Let me start by saying the correlation between gold and other markets such as stocks or bonds or anything kind of fluctuates. So it's not always an absolute, but conventional wisdom expects gold to trade higher when stocks are selling off and vice versa. But that really just isn't always the case. And especially if you look at a gold chart, like a monthly chart of gold versus the S&P, somewhere along the line, and I would basically argue that around the time that 2020, 2021, when a lot of liquidity came into the system to combat the COVID or the COVID shutdowns, whatever you want to call them, a lot of liquidity came into the system, and somewhere along the line, gold became a risk asset. And what I mean by that is the gold and the S&P started trading in lockstep together overall. And the big rally that we saw in gold was matched, not quite matched in magnitude, but matched in direction by the S&P. So gold is basically, at this point, it's not really diversifying anybody's portfolio. It's actually adding risk to their stock portfolio is what's going on. Unfortunately, I don't think a lot of people realized that when they were buying gold late 2025, early 2026. I think people were assuming it was some sort of a hedge against global turmoil, that sort of thing. And it's turned out to be the opposite. And I'll also add, there were a lot of reasons to be long gold in the beginning. Like when we're talking $2,000 gold, maybe even the high twos, low threes. There's good fundamental reasons to be long gold. Inflation was hanging around. There's a lot of uncertainty on the global stage. So I'm not saying there was no reason to be long gold, but I do think that the market really got over its skis by probably 2,000 points, to be honest. I don't think gold had any business fundamentally being above 5,000, probably even above 4,000, but sometimes markets do that. It kind of, in my opinion, and I know a lot of people have differing opinions, but to me, it felt a lot like a meme stock or like GameStop, where the idea went viral, the narrative went viral, and everybody was buying because of the narrative, but they weren't paying attention to price or risk. And eventually those things do matter. And I think that's what we saw when gold started correcting a month or so ago.
Very, very interesting take on gold. And I wonder, with that in mind, where does the gold price go from here? You mentioned maybe it didn't have any business being above 5,000 or even 4,000. Of course, right now we are still above 4,000. So what do you see coming?
So we've seen a couple of things that are red flags to me. We've seen really massive spikes in volatility in the option market, and obviously volatility on the price chart if you look at the price of gold. We've seen this a couple other times in history. In 1979-80, we saw gold behave like this. In 2011, we saw gold go parabolic, not nearly to the nature that we have seen this last year, but it was a similar pattern. And in those previous two instances, that was the high in gold. It wasn't the beginning of some giant bull market in gold. That was actually the end of the bull market. And when I look at historical volatility, implied volatility in the option market, when we see these really massive pumps in volatility, those are generally occurring at trend changes, not at the beginning or middle of a trend, but at the end of a trend. So my best guess is we've probably seen the highs in gold, but that doesn't mean we can't get some really sharp back and forths here in the meantime. In fact, the downtrend line comes in somewhere around 5,300, if I'm correct in my memory. So it's very possible we poke above 5,000 on this snapback rally before sellers really start coming back in. But I do think in the overall scheme of things, again, if you look at 2011 and 1980-ish, you'll see that these types of explosive parabolic rallies are proved to be unsustainable, but they also prove to be kind of hotbeds of volatility for the next several months while the market works it out. And that means we're going to have big rallies, but also big sell-offs.
Again, very interesting. So more volatility potentially ahead for gold. And of course, it's not really supposed to be a volatile asset either. So if we take a step back for gold and we look at the overall cycle, where would you place this at the moment for gold?
As far as the overall cycle, I think we're going into a bear market. In the last couple of occasions that we've seen this type of behavior in gold, and you make a really good point. People call gold a safe haven asset, but I've been doing this for over 20 years, and there's really nothing safe about gold. It can get really, really wild at times, just like we're seeing. It doesn't pay interest or dividends. And, everybody likes to talk about how quickly gold has risen the last couple of years, and it's been amazing, but it's also padded the numbers. So if you start looking at performance of gold versus the S&P, it looks really, really great at this point in time. But I remember in 2011, they also looked great. Everybody was saying, gold's outperforming the S&P, this, so on and so forth, exactly what we're hearing today. But then gold went in a 9 to 10 year bear market. So we have to be really, really careful. Just because the numbers look really great today doesn't mean going forward it's going to be the same. In finance, they always say, past results aren't indicative of future results. And that's exactly what I think we're looking at in gold. So although I do believe we're going to have some really big rallies and some working out to do, I think the big picture is we're going into a bear market in gold.
So how would you be approaching gold at this point? Would you be trading at the time, and what would you be looking to do given the circumstances that you're outlining?
That is a great question, and I wish I had a magical answer, but the reality is gold is so difficult to trade at this particular time. The margins are very high, so if you're trying to trade in the futures markets, the margins are so excessive, and for good reason. Margins are high because volatility is high, and it's a risky market at this particular time. So the margins are so high, it's difficult for a lot of traders to get involved. And if they do get involved and they try to do, conventional risk management, like place stop orders, they're almost guaranteed to get stopped out before they see any positive results. So it's a really very, very difficult market. And lastly, if you're the type of person that's trying to just buy options to keep your risk limited, on the surface that sounds like a great idea because I just mentioned the margins are high. So buying a call sounds like a great idea if you think gold's going up. But the problem is option markets are always priced to lose and calls are very, very expensive. So you're talking about risking several $1,000s on an option that's quite a ways out of the money. So there's just no easy way to play gold. My best advice would be paper trade it, stay on the sidelines. Or if you're a long-term investor, maybe I'm talking long-term like decades, not months or weeks. If you're that type of investor and you want to buy some gold, maybe do it in an unleveraged way, bullion, or maybe even an ETF, but go very small. Gold's the type of market you want to buy it when nobody wants it, not when everybody wants it. And so although we're on an upswing and I think we have some way to go on the upside, timing it and getting out isn't going to be that easy. So caution is warranted.
Fair enough. And we do, I think, have many people in our audience who are those very long-term gold holders. So that could apply there. You had mentioned the relationship between gold and the stock market and how maybe gold wasn't providing that diversification that people might want to see. So what do you see coming from the stock market in that case, in a broad sense, given what we've talked about for gold?
Well, I mean, the stock market is obviously in a corrective mode. We're getting a really nice bounce here over the last couple of days, but war markets and bear markets see really big bounces. I'm not sure I'm convinced that the lows are in the stock market. In fact, there's some pretty good resistance coming up here in the next 100 points or so in the S&P. So we have to be really, really careful with what we see here. And also, again, I've been doing this for a long time. This has been one of the most tremendous bull markets of all time. If you're looking over the last several years, it's just been a doozy. But I am old enough to have experienced the global financial crisis. And I do remember there were, from early 2000s through the financial crisis in the early 2010s, there was over a decade where nobody made any money in stocks. It was just kind of dead weight. So history suggests that eventually we're going to get back to that stage. I don't know if that's this year. I don't know if it's 5 years from now, but we should always keep that in the back of our minds. So I personally would be, I'm not saying don't take any risk at all in the stock market, but I am saying we should continue to be cautious because I don't think we're out of the woods just yet. There's going to be a lot of volatility in the headlines. And it is a midterm election year. Midterm election years usually have really rough Aprils. So there's a lot of things working against the stock market at this particular time. So I'd be very careful of chasing prices higher into bounces. If you're a long-term investor, the odds are you probably get a better dip to buy into.
All right. So again, that caution. And while we're on precious metals, I want to bring up silver as well. I'm curious if your outlook there is similar to gold or if it's different. Silver, of course, it's got its precious side. It's also got the industrial component that can make it a little bit different. So are you seeing similar times ahead for silver or something a little bit different?
My outlook is pretty similar in silver, which is not optimistic. I actually am in the middle of writing an article for our Substack that is comparing what we saw in silver over the last 6 months to what we saw in GameStop in 2021, 2022. And it's really crazy. If you overlay the charts, they're almost identical to the parabolic moves in GameStop and silver. And when I think about it, I think a lot of the cards align. I realize GameStop is kind of a worthless, I don't want to say worthless, but not the most valuable company in the world. And silver, as you mentioned, has a lot of properties, industrial properties that make it valuable. But if you take out those two factors and just look at the environment as a whole, there's a lot of similarities, kind of meme stock piling on of a certain idea, a lot of out of the money call option, pump and dump schemes going on online. And so I feel like we've GameStop silver. And I hate to say that because as a commodity broker, I encourage speculation in commodities. But I think things have kind of went off the rail with silver. And I didn't really like what I saw. There was way too much volatility that had nothing to do with fundamentals. I think the market detached itself from fundamentals, and that's a dangerous game in the long run. So I do think silver probably saw its high in the 120-ish area. And I think we're like gold in the middle of some switchback volatility, which, to be fair, could easily see $90 in silver, maybe even $100 in silver. So you have to be really careful. Sometimes these parabolic moves, as they flip from a treacherous bull market to a treacherous bear market, we usually get several months of back and fill before it finally succumbs to gravity and just kind of trades lower for several years. That's been the pattern in gold and silver. But the snapback rallies could be very, very sharp. And what it does is it makes the, people that bought into those narratives and headlines, and I'm not saying they were wrong. I'm just saying you couldn't justify the pricing with those headlines, in my opinion. So a lot of people will hang on to those narratives and ideas. And, if they liked it at 120, they're going to like it even better at 60 or 70. And so that's why you get these really big snapback rallies. But the eventual outcome is probably going to be similar to GameStop, where we give a lot of the gains back and go back into a subdued trading range.
Well, and for silver, it's very interesting because we made it past that $50 level and, of course, much, much higher, as you're talking about. And I think many people still think it can go higher again. But there's also the question of, all right, if we stay lower, do we stay in a range that's above that $50 level? Are we in, some people are calling it maybe a new paradigm for silver, or do we go back to where it was before, below that $50 level? So any thoughts on that?
Well, that's an amazing point. I would agree with you. I think we at least see 50, and then we'll just kind of have to see what it does with that. I personally think we probably get into a range between 30 and 50. I think that's probably the fair price. That's my guess. the US dollar, you have to recall a lot of the narrative behind the silver rally and the gold rally was the US dollar is weakening and so on and so forth. And if you're looking at the dollar against other currencies, it's actually rallying this year. It's not weakening. And I know the argument was also fiat currency losing its value. But when war broke out, the first thing that the world did was buy US dollars. And the treasury market has sold off a little bit on the war because of expectations of inflation, but it didn't sell off that much. In fact, we haven't made new lows relative to last year's lows. So I would say there's still some interest in money flowing into the dollar and treasuries. And so that isn't necessarily indicative to the bullish case in metals. So I do think that chances are silver trades below $50. The time frame is uncertain. Maybe it takes 6 months, maybe it takes a year, but I think we do see it.
Yeah, I think timing is always very tricky to get. And talking more about volatility and what's happening with the war, I want to shift over and see what's going on in oil prices. So there's been a lot of interesting price action. Prices have been above and below the $100 per barrel level. And there's so much uncertainty right now. What do you see coming for oil prices? Where do we go from here? What can we say at this point?
So obviously, we can't see the future. All we can do is judge what's happened in the past and try to make guesses. So that's what I'm doing. I'm kind of focused on what happened in 2022. In 2022, Russia invaded Ukraine, and the oil market rallied very sharply to about 130. Not unlike what we just saw. It was a very sharp rally, and the idea was Russian oil was going to be sanctioned, and all that supply was going to be taken off the board, and we were no longer going to have enough oil to supply the global market. That war is still going on. Russia's oil is still sanctioned, yet we found a way for oil to get down to 55 after all of these things. So I think, all I'm trying to say is the market has a tendency to price in the worst case scenario. But oil is a very important commodity to literally everyone on the globe. And somehow or some way, people generally figure it out. They figured out a way to get around the sanctions. The Strait of Hormuz is maybe a little more difficult, but you already see Saudi Arabia using pipelines to get a good chunk of their output, out on a different part of the country. Pipelines take a while to build, but I would suspect this is going to be a lot like 2020. In 2020, we experienced COVID, and then in the U.S., we decided, our supply chains were working very well before COVID, but then we realized we were too reliant on countries that we couldn't trust. And I think the oil industry is going to basically come to that same conclusion. I think everybody had this in the back of their mind. We all knew that someday the Strait of Hormuz could be used as a weapon, but nobody, until it actually happens, people put off and, procrastinate making a plan. Now that it's happened, I think that everybody's going to put a plan together. So 5 to 10 years from now, I don't think the Strait of Hormuz is going to be the chokehold that it is today. I don't think it'll be possible to shut down that much oil in one little area of the world. I think people work it around and it figures itself out. That said, as far as what happens in the next 6 months, I think we do get a repeat of 2022 because while it's true, the strait is mostly closed. There's some oil that's been sidetracked and getting through, and that's a problem. But I'm trying to be optimistic, and I think that everybody will work it out and the oil will start coming through again. And if it does, in the meantime, we've added supply from Venezuela. We've added supply there's some California offshore rigs that have been in retirement for 10 years and they're coming back online. Every small producer in the country sees these prices and they're starting to pick up steam. So I think we'll actually, we went into this war with an oil glut, and I think we probably come out with a bigger glut at some point. Again, is it next month or is it 5 months from now? I wish I knew, but I think that's ultimately what we're going to see.
That would be very interesting to actually come out of this with more supply than we had before. Yeah. And so I'll ask again. So this again, it's a tricky situation. How are you approaching this from a trading standpoint? Because it seems like another one where it's probably pretty difficult to make moves with certainty.
Yeah, interesting. Crude oil's been wild, but it's actually been a lot easier to manage than gold and silver were. The gold and silver were so off the charts wild. Oil's done this before. Gold and silver had never behaved the way that they did before. So that was new territory. And why that matters is the option market in oil has been very functional. It hasn't broken at all. In fact, it's been very civilized and very fluid, and the bid-ask spreads are tight. The futures markets have had some big moves, but margin increases have been reasonable, and everybody's kind of been able to cope with it mostly. We were lucky because going into the war, we were expecting, let me put it this way, March is usually a really crazy month for oil. You usually get some really big volatility in March. I'm not sure why it happens. I haven't been able to figure out why, but it just always happens. So we were expecting volatility, but we were expecting it to be on the downside because we were in a glut situation. We just didn't see a war coming, so that changed things on a dime. But we had purchased deep out of the money puts, hoping that volatility spike would be in the downside. We were wrong, but it's okay because we luckily didn't have any upside, unlimited risk. But as prices have rallied, just a couple of days ago, we actually were comfortable enough to sell calls and buy puts. And the reason we do something like that is the market's wildly volatile. The option market's pricing in tons of volatility. So we were able to sell strike prices $30 out of the money for $4,000 or $5,000, which is really, if you've ever traded oil before, that's really impressive. Usually $30, $40 out of the money are worth $200, $300, not $5,000. So there's a lot of premium out there. And we used those short call sales to finance the purchase of puts or put spreads. And we did it that way. But yet you have to be very, very careful. That's not for everybody. That's, I'm not recommending anybody do that. I'm just explaining how we do it. If you're a speculator, but you're not willing to sell naked calls, I don't blame you at all. The CME actually has micro futures that are small enough that you can trade them and not get your head ripped off, even if you're a little wrong. So if you like the simplicity of futures, try using the micros.
Appreciate the different ideas for people with different comfort levels. And on the note of oil prices, I want to ask about inflation because I'm seeing a lot of concerns about what happens to inflation due to higher prices. And maybe we could focus on the commodity sector because I'm hearing, for example, concerns about prices for miners that use fuel and that kind of thing. So what do you see coming on that note?
Well, one thing that I should have mentioned in the last question, I'm just going to offer that real quick. Another way to play crude oil is to find a market that's a lot tamer, but is correlated to it. So, for example, the Japanese yen has been selling off in lockstep as crude oil went up. The options in the yen market are very, very cheap for literally far less than $1,000, $600-700. You can buy an option with 3 months that isn't very far out of the money. If oil reverses lower, the yen will go up, and you can make money that way. So that's one thing to keep in mind. As far as the inflation goes, it's a little bit tricky because if oil spikes higher while the economy is really hot, that's inflationary because it raises the prices of everything and there's too much money chasing too few goods and prices go up. But going into this war, we were starting to see some of our economic numbers crack a little bit. The jobs numbers were softening. Now, whether that continues is still a question mark, but I would argue that in this particular case, the economy was starting to slow down just a little bit, and oil spiked so quickly. Like if you filled up your car, gas is probably about double what it was pre-war. So that takes a lot of money out of the economy, out of consumers' pockets, and it really puts a big chokehold on the economy very quickly. So I actually think this particular spike is not inflationary at all. I think it's deflationary because I think it takes way too much money out of the economy to keep us going on all cylinders. So we'll have to see how it pans out. But I'll also point to 2008. In 2008, oil rallied to $150 a barrel very, very quickly. And during that time, we were in one of the most prosperous economic conditions of all time. But the rally in oil actually popped everything, and we went into the financial crisis short after. So when oil spikes this sharply, sometimes it breaks things in the economy, and it puts us into recession. 2011, we saw something similar. So 2022, when oil spiked, we didn't go into a recession officially, but if you recall, the administration changed the rules on what constituted a recession. So maybe we did. But I'm just saying, I actually think this is deflationary, not inflationary, because I think it slows down the economy enough to do just that.
Yes, yeah, I do remember changing that definition again, very tricky. Okay, that's really interesting. So deflation potentially ahead. I was going to ask, I had in mind to ask you about these stagflation type of headlines that I've been seeing, but instead maybe deflation. Anything further you would add on that? Because it's not a scenario that I've heard talked about very much at this point in time.
You're right. It's kind of the popular narrative is, and I think most people are assuming that we're going to get a repeat of the 70s or even a repeat of 22, where we had an energy crisis and the price of everything went up. But I'll remind people, the U.S. is mostly energy independent, not completely, but if you look at natural gas prices in the U.S. versus what's going on overseas, it's actually quite stunning. Our natural gas prices are under $3, and in Europe, they're contending with just parabolic pricing over there. And that's a lot different than what we've seen in the past. And it's because U.S. producers have done a really good job at becoming independent. In oil, we still import some oil, so we're not fully independent. But WTI, which is the U.S. crude oil benchmark, is trading much lower than Brent. And that tells us that we are at least a little bit sheltered. So the reason I'm saying this is I don't think the 70s scenario is a real likely possibility because we are such a big oil producer in this environment. And 2022 is a little different also, but I think I just personally think the U.S. economy's kind of been running on the steam of money printing for so long. I think we're due for a nice just reset of everything, in my opinion. And I think hopefully our central bankers allow that to happen. In the past, any sign of trouble, we start printing and printing and printing to work our way out of it. But the natural business cycle, it comes with booms and busts. And I hope we go back to that cycle because I do think it is a healthier environment. And for all of us, I'll just leave it.
Yeah. Well, and that is also an interesting point because we're approaching our Fed chair transition where it looks like we should have somebody new coming in who might be more in agreement with what President Trump would like to do. So how does that, I guess, play into your expectations for the economy?
Well, it's interesting when silver and gold peaked, it was literally right around the day that President Trump announced that he was going to appoint Warsh as the Fed chair. And I think there's a reason for that. I think that kind of popped the debasement trade because assuming he gets confirmed and everything goes as planned, he is somebody that has acknowledged that the money printing has created some bubbles and some problems in the economy and isn't a long-term fix to our problems. So I do believe that, I do believe that we enter into a kind of a new era of less government intervention and hopefully more free market.
Well, it seems like we kind of came full circle. We're back around with gold and silver again. So we can start to wrap it up. I wanted to ask before I let you go, looking at the commodities sector, we've gone through some of the main topics that we typically look at here on our channel. Are there other areas of opportunity that you would highlight, things that you are really paying attention to right now?
So some interesting things in this environment, whether you're trading grains or literally anything you're trading oil because everything is moving either with or in opposite of oil just due to that's how war markets work. So if you are somebody that follows the grains, so corn, wheat, soybeans, I would probably suggest if you've made money on the upside, probably take some profits because the issue is we're following crude higher, but if you take the crude oil trade away, grains are going to have a hard time holding these levels based on their own fundamentals. So we're playing the downside in some of those grains, not heavily and with limited risk, because if we were wrong in our assessment, commodities go down more than they go up, but when they go up faster than they go down usually, just like we've seen in gold and silver. So you have to be careful. But I think being bearish in the grains is probably a good idea. And I'll mention the yen one more time. The yen is really, really suffered for many, many reasons. There's all kinds of things going on. The infamous carry trade has kind of pushed it lower and lower over the years. The energy crisis that we're currently going through has been really a headwind for the yen. But we're sitting at multi-year lows, near almost an all-time low. The option market is still pricing in very low volatility, so it's not that expensive to speculate on the yen reversing course. And I'm not saying there's fundamentals there to suggest that we reverse course, but again, if the war ends and crude oil comes down, that's going to push the yen higher. But more interestingly is the Bank of Japan has a habit of intervening in currency markets. It does it every once in a while, and when it does it, the yen makes really big moves. So for a very small amount of money put on the table, you can actually play the yen in a pretty decent way.
Okay, well that'll be a good one for people to look into. And I'll let you go unless you want to let everybody know where they can find you online if they want to hear more.
So I appreciate you having me. Again, my name is Carley Garner. I'm with DeCarley Trading. Our website's decarleytrading.com. You can also find us on X. And if we are a brokerage, but if you're not interested in brokerage services, if you just want to hear commentary, see some charts, that sort of thing, we have a Substack. You can visit us at decarleytrading.substack.com.
Perfect. Well, we'll have your links in the video description so people can check them out. Thank you so much for coming on. This was great, really informative. And once again, I'm Charlotte McLeod with investingnews.com, and this is Carley Garner with DeCarley Trading.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.